How did bank runs lead to the Federal Reserve System? Have you ever wondered how a series of bank runs could lead to the creation of a central banking system in the United States? It's a fascinating story that reveals much about our financial history. Bank runs happen when many customers withdraw their money from a bank at the same time. This usually occurs because people fear that the bank may fail. Banks typically lend out most of the money they receive as deposits. They only keep a small portion as reserves. When too many people try to take out their money at once, banks can run out of cash. This creates a liquidity crisis, and often it leads to bank failures. In the late 19th and early 20th centuries, the United States faced numerous bank runs and banking panics. One of the most notable was the Panic of 1907. This panic was triggered by failures in speculative investments, which caused people to lose trust in banks. As fear spread, bank runs became widespread, leading to the collapse of several banks and trust companies. During this time, private clearinghouses stepped in to provide emergency loans. However, these temporary solutions highlighted a major issue. The banking system lacked a central authority to provide liquidity during crises. Without such an institution, individual banks were left vulnerable to runs that could quickly spread and threaten the entire financial system. The Great Depression further illustrated the dangers of bank runs. Many banks failed, wiping out personal savings and shrinking the money supply. This situation worsened economic downturns and led to a loss of public confidence. People began to panic and withdraw their money, creating a vicious cycle. In response to these challenges, the Federal Reserve System was established in 1913. The goal was to create a centralized banking authority that could manage the money supply, supervise banks, and act as a lender of last resort. This means that during times of crisis, the Federal Reserve could provide emergency funds to banks facing sudden withdrawal demands. By acting as a safety net, the Federal Reserve helps to maintain public confidence in the banking system. It ensures that solvent banks can meet withdrawal requests, which helps prevent the spread of panic. The creation of the Federal Reserve System was a direct response to the vulnerabilities exposed by repeated bank runs. It was designed to stabilize the financial system and protect the economy from the damaging effects of bank failures.